Good morning. This is Glenn Solomon with Offit Kurman, and we are pleased to present you with a PPP loan forgiveness program. That here at Offit Kurman, we have developed a CV-19 business response team that is comprised of 8 of our lawyers, 4 of whom are on this video presentation with us now. Joe Armstrong from our Philadelphia office.
Morning, Glenn.
Good morning, Joe. Max McCauley also from our Philadelphia office. Morning,
Good
Max.
morning, Glenn.
Steve Luker from our New York office. Good morning, Steve. And me, Glenn Solomon. So we're pleased to present this program for you. A lot of our clients have obtained PPP loans, and now we're into the process of them seeking forgiveness of the loans. A somewhat complicated process, but we're here to give you this PPP primer, or as I call it, will you forgive me? And we're going to start off with, many of you know that you can borrow PPP money for a lot of things, a lot of different costs, but the field of costs and expenses that can be forgiven are narrower than the field of costs and expenses that one could obtain a loan for. So we're going to start off talking about those costs and expenses that can be forgiven, and we're going to turn this part of the program over to Max McCauley. Max, take it away.
Thanks, Glenn. So there are 4 main costs that you can seek forgiveness for. One is payroll cost. Second is interest on mortgage obligations on real or personal property in effect before February 15th, 2020. The third is rent on real estate or personal property leases, again, in effect before February 15th, 2020, and utilities. Now we'll drill down a little bit on each of those. Payroll costs include the gross wages paid to your employees. In addition, other payroll costs are bonuses. Now, bonuses may need to be prorated if they're based on a period of 12 months as opposed to the covered period under the PPP program. You're going to hear more about the covered period a little bit later. The vacation sick leave, that's covered as well, and that would include vacation, parental leave, family leave, medical leave, and sick leave not credited under the Families First Coronavirus Response Act. Group health care premiums paid by the employer, a 401k match paid by the employer. Those are both considered payroll costs under the PPP program, as well as payments to furloughed employees. Now, a tricky one is state and local taxes paid by the employer based on payroll. Now, these aren't the state and local taxes that you would see taken out of the gross wages. This reference in the PPP program is to employer paid state disability insurance and state unemployment insurance. And again, note that the employer portion of FICA, that would be your Social Security and Medicare contribution, is not deductible, but the portion that was included in gross wages is a payroll cost. So again, gross wages is the starting point, and then you add all these other items: bonuses, vacation sick leave, healthcare premiums, 401k match, payments to furloughed employees, and these state and local taxes. Now, independent contractors and Schedule C business owners have not been left out. If you look at the 2019 IRS Form 1040 Schedule C, line 31, you'll see the net profit for these individuals that have received loans. Now, their maximum loan is $20,833, and that is for an independent contractor with no employees. Of that maximum loan amount, $15,385 was eligible for forgiveness as owner compensation replacement, and the balance can be forgiven if spent on approved expenses. Now, again, you're going to hear some changes that were just made yesterday to that proportionality, and Joe Armstrong will cover that here shortly. Second category that I mentioned earlier was interest on mortgage obligations on real or personal property in effect before February 15, 2020. So all mortgage interest payments are allowable and forgivable. However, and that is obligations on real or personal property. However, interest payments on other debt obligations would be an allowable use of your PPP funds, but it would not be a forgivable use. Rent on real estate or personal property leases in effect before February 15th. We covered that before. That's your third category. And the fourth, again, a little tricky, utilities. What they mean by utilities is electric, gas, water, telephone, cell phone, and internet access. All if they were expenses of your business in effect before February 15th, 2020. Now, there is an item that's omitted from that list that we get a lot of questions about, and that's transportation. Now, transportation is a utility, is actually a financing mechanism used by some metropolitan areas whereby businesses and residents are charged fees based on estimated trip usage. That doesn't apply to most of our clients, and it's very confusing. So for the most part, transportation isn't going to be an expense that our clients are going to have as an allowable PPP expense. That's it for the four categories, Glenn.
Thanks, Max. So question on
Yes.
the payroll costs and the bonuses. So suppose that one of our clients wants to pay a stay or a retention bonus to a key employee. Is that the kind of bonus that could be included in cost to be forgiven?
It is, but the total wages for that individual are going to be capped at $15,385. And again, that might change as a result of the law, that the amendment to the PPP program that just was passed by the House earlier, I guess last Friday, and the Senate yesterday, and is yet to be signed into law by President Trump. But they will be capped at a certain dollar amount for the period. Right now, it's at $15,385. So yes, Glenn, that can be done. Again, be careful with the pitfall. Is the bonus based on 12 months of performance, or was it based on the covered period? It has to be a bonus incurred during the covered period and for the covered period. If it's larger than the covered period, then you'll have to prorate.
And question about the interest on the mortgage obligations. As you mentioned, it's the mortgage obligation. A lot of people think of a mortgage obligation per se as something dealing with real estate. But here they're using the term mortgage obligation as something with real estate, or what we call as lawyers personal property. So am I correct to say that if you have a copier, one or more copier or computer equipment leases, and there is a loan which is secured by those assets, and the interest on those loans paid during the covered period would be forgivable?
Yes, the interest portion of the loans, not the principal portion, but the interest portion, yes.
Right. Okay. Terrific. Well, Max, thanks for that recap on the coverable, forgivable cost. We're now going to, that was what is forgivable. Now we're going to go into a few items on the when. When are these items forgivable, or when do these items have to be paid or incurred? And to talk about that, I'm happy to introduce Joe Armstrong from our Philadelphia office.
Thank you very much, Glenn. All right, so yesterday the Senate passed the Paycheck Protection Program Flexibility Act of 2020. This modified some significant requirements for forgiveness of the PPP loans. The most striking change was the limit on non-payroll cost has been increased from 25% to 40%. This was in response to comments from small businesses with relatively high overhead cost compared to their payroll. Picture a retailer in a high rent district. They may struggle to use 75% of these funds on their retail personnel because their rent is so disproportionately high compared to that expense. This is anticipated flexibility that will give small businesses more access to forgiveness for these loans. Now, there is a major caveat here. In the act that got passed by the Senate yesterday and now is headed over to the White House, there's a new sentence added that suggests that if the employer does not use at least 60% of their loan proceeds for covered payroll cost, they will be ineligible for forgiveness at all. Perhaps this will be a fix. Perhaps it was an intentional trade-off to go from the 25% limitation and take that up to 40% available for non-payroll cost. But we will need to wait and see guidance from the SBA on that one. Next, we have the concept of paid or incurred. Eligible cost can be either paid or incurred during the covered period. Now, sometimes when you're dealing with payroll, you will have an instance where the payroll periods of the employer do not line up with the rigidity of the act. So under the act as it stands now, you can include payroll that was paid during the covered period or incurred during the covered period, so long as it's paid on the employer's next regularly scheduled payroll date. You can also include non-payroll costs incurred during the covered period, so long as they are paid during the next regular billing cycle after the covered period. So what is this that we're talking about with the covered period? Well, big change yesterday. The covered period was 8 weeks. There were many complaints from employers that that was too short of a time frame to utilize all of their loan proceeds and still qualify for 100% forgiveness, which was the intention of the act. So the covered period has now been extended from 8 weeks to 24 weeks. And instead of ending on June 30th, 2020 as a key date for several reasons, that date has now been pushed out to December 31st, 2020. The covered period begins on the day that the employer actually receives the loan proceeds, and it goes from that period on. If it's better for an employer, just for payroll, you can utilize an alternative covered payroll period. That still now was expanded to the 24-week period. And this one, if you choose the alternative, instead of beginning on the date that the employer receives the loan proceeds, it can begin on the date of their first regularly scheduled payroll period that falls after the date they receive the loan proceeds. So it's an option. The employer can pick it, and they just have to do the math to see which one is better. For non-payroll cost, the cost must be paid during the covered period, and as we said again, paid during the next regular billing cycle for the expense. The amendment does extend that out for 24 weeks as well. There was some talk that that may only apply to payroll cost, but it does appear that it's going to be covered for non-payroll cost. So an example of that would be a utility bill. You may pay a couple bills during the covered period, and then after the covered period, you pay a utility bill that includes charges incurred during the covered period. That would be fine. You just have to do the math to allocate the portion of that utility bill to the charges incurred during the covered period.
Good. Well, terrific. Thanks for that recap, Joe. Appreciate it. So now we're going to go into, you're thinking that, I got the loan, I got the PPP loan, and now I'm going to apply for it to be forgiven, and I'm set. That 100% of the loan, as long as I use it for the appropriate costs and expenses, is going to be forgiven. But there are some potential reductions in the amount of the loan that can be forgiven. And Steve Luker out of our New York office is going to talk about those potential reductions. Take it away, Steve.
Thank you, Glenn. So what we're trying to do is essentially, when I think about legislation, it's always helpful to understand what's the purpose, what is the Senate and the Congress trying to do. In this case, they're looking at companies and saying, how have they suffered? How can we keep them employing people after a period, which is the coronavirus hit, and comparing it before? So as Joe is talking about the covered period and looking at that, that was the period post coronavirus, post the act. And then we're going to be looking at a period before the coronavirus hit. And there's two ways that you can have this potential forgiveness amount. Again, the loan that's being dispersed can be potentially forgiven if it's used for the right purposes, as Max and Joe both spoke about, with possible reductions. The first reduction is a salary reduction. And you would be looking at a period before the coronavirus hit, before the legislation initially came through, and that period would be the first quarter of 2020. So from January 1 of this year through March 31st of this year. And these reductions would be applied on an employee by employee basis. You would look at certain qualified employees, which is defined to be employees who have received $100,000 or less in any payroll period on an annualized basis. So that means you would look at each pay period, figure out how much that individual employee has made. If it's less than $100,000 on an annual basis, then they would be considered in this calculation. Then you would look at the employee, again, individually, and say, and look to see if there's been a reduction that exceeds 25% in the post period, in the covered period, versus Q1 of this year. To the extent there had been any reductions that exceeded that 25% threshold, that excess would be deducted from the potential forgiveness amount, and you would aggregate that for all your employees. And when you look at the application for forgiveness, which Max will talk about further, there's schedules and then worksheets to the schedules where you fill those out for each employee. So once you've reduced the potential forgiveness amount by that payroll reductions, which you've aggregated for each employee, then there's an additional reduction that could happen that's based on a headcount fraction. And that headcount reduction is based on what they call full-time equivalent employees. There is a reference period that looks at the time period before the coronavirus hit. If you're a non-seasonal employer, you have two choices. You can choose from either January 1 of this year through the end of February, that's February 29 of this year, and look at your employees during that period, or you can look back to 2019 from February 15, 2019 through June 30 of 2019. Now, if you happen to be a seasonal employee, you can look at either one of those periods or at a third period, which would be any 12-week consecutive period between May 1 and September 15th of 2019. There's instructions for how to do this in the forms and in the schedule, but for each employee, you would take the lesser of the average number of hours that they worked per week, and divide that by 40, and round to the nearest 10th, or you would take 1. The reason why they have 1 is you can only count any individual person as one employee. So you would add up all those numbers, and that would give you your head count for your what they're calling full-time equivalent employees. And then you would take that number you would calculate it for both the covered period, meaning after loan issuance, under now the 24-week period, and you would compare that to the reference period, being the period beforehand. And that fraction would be the full-time equivalent employees would be the numerator in the covered period. The denominator would be in the reference period, meaning the period before the coronavirus, and you would multiply that fraction times the potential forgiveness amount, which has been reduced by the salary reduction. So it has the effect of proportionally reducing the forgiveness amount based on if you've maintained the same level of full-time equivalent employees. And that order of operations is important to understand as employers are calculating the impact. First, you have to reduce the potential forgiveness amount by the salary reductions. Secondly, you apply this fraction.
Okay, well, thanks for that explanation of a somewhat complicated exceptions to the forgiveness. So you have to be very careful when calculating that for sure. So we know as lawyers that there are always exceptions to the laws, and often exceptions to the exceptions. And here we have some exceptions to the exceptions that Steve Luker just reviewed. And Joe Armstrong is going to talk about those exceptions to the exceptions.
Thanks, Glenn. As Steve was saying, it's important to look at the intent of Congress when you're trying to interpret the law. And here it's to keep people on the payroll as opposed to putting them in the unemployment line. So when the coronavirus first hit and the governmental stay-at-home orders and shutdown orders were coming out, many employers had a knee-jerk reaction to have mass layoffs because they knew there'd be no revenue coming in and they would not have the cash flow to support employment. Once the CARES Act got passed, there was discussion about, well, how are we going to get employment levels where they need to be? It took us longer than anticipated to get this act through. So After looking at all of the guidance and now another amendment here to the act, we see that there are some public policy exceptions to go with the law. First, if your employment level has fallen below the required threshold, you now have up until the end of December 31st, 2020, to rehire people and get folks back onto the employment rolls. Now, employers are faced with situations where they're prepared to rehire the employee, but for one reason or another, they can't. So the exception to the exception in this instance requires significant record keeping, but it will cover the employer when you have situations such as you offer to rehire the employee and they decline, or you offer to restore their hours to the level where they were before they were laid off, and they also again decline. So what the employer needs to do in this situation is make a good faith offer in writing to the employee to restore their employment or restore their hours as it applies. It needs to be the same pay and hours. The employee has to reject this offer, and you need to keep a record of the rejection. The employer has to notify the state unemployment office that they offered employment or an increase in the hours to this employee and it was rejected. That's a significant policy instance here because the goal here is to keep people on the payrolls of a private employer, not to have them in the unemployment compensation line. Right? Then there's another exception that we have because things happen in business, even during the coronavirus. So if an employee is fired for cause, or resigns, or actually requests a reduction in schedule. For instance, they may not have daycare available for the children like they used to. That is another instance where the employer can document the situation, and that particular employee under those circumstances will not be held against the employer in the calculations. Now, regarding cause, that's a vague term. It has not been defined in the statute. We're not certain if the SBA will issue any guidance for determining cause. But because we see that a report has to be made to the state unemployment compensation agency, we can speculate with a little bit of confidence that the standards used by the unemployment office to determine whether someone was fired for cause may apply in this situation.
Thanks, Joe. Thanks for that discussion of the exceptions to the exceptions. And I think your latter point is very interesting because, as you said, even during periods like this, things happen, and it is necessary to terminate an employee, although rare they happen for cause. And so, some of our clients may look to a state unemployment rules for definitions of cause or comparable terms in the relevant state statute. Our clients may look to whether their particular employee has an employment agreement, which defines cause. As you said, it's not defined in the statute yet. So I think this will be a interesting and evolving issue to the extent it comes up during this period. Well, thanks. So we've talked about what can be forgiven. We've talked about some limits on that. The when the cost can be incurred, what's the covered period. We've talked about the exceptions to the exceptions. And now we're going to talk about the how. How do you get a loan forgiven? And Max McCauley is going to take over from here and talk about the process of getting a PP loan forgiven. Take it away, Max.
Thanks, Glenn. So similar to when the borrowers applied for the PPP loan, they went straight to the banks, not to the SBA. The same is true for the forgiveness application. So borrowers will submit the PPP forgiveness application to the lender, not the SBA. And it was recently released. It's 11 pages, including instructions, worksheets, tables, formulas. It's quite involved. So far, it's been useful for our clients, I know, to have their accountant as well as their lawyers on a joint call with management to help the ferret through the process of filling out the application. And I say that because the application is certified, meaning just like the application for the loan, there is an entire page of certifications that the borrower will make, that they have verified that the information on it is true and accurate, that the uses were appropriate, and how the funds were maintained was appropriate. So it's very important to understand the certification and to fill it out correctly the first time. And I say that because once the application is submitted to the lender, along with certain documentation is required to be submitted, and we'll get into that in a minute, and certain other documentation the borrower must maintain but is not submitted. Then once the lender receives the application, they have 60 days to make a determination on the amount of forgiveness that's going to be permitted, and the lender also submits the request to the SBA. The SBA has to review that. Now, there are a few particular issues to keep in mind as well. Many folks received the $10,000 emergency EIDL grant. It was in advance months ago or in early April. And that $10,000 EIDL emergency grant will reduce the amount of forgiveness by the $10,000 or the amount that they received. And so some employers might have received less than 10,000. It was based on the number of employees you had. So if you only had one employee, you might have only received 1,000 of your 10,000 that you applied for. But in any event, that amount's going to reduce your forgiveness. Also, loans of $2 million or more most likely will be audited. Loans under $2 million may not be, but that doesn't change the record-keeping requirements that are placed on all PPP borrowers. So let's get into the documents first that we're required to submit with the application, and then we'll talk about other documentation that you should keep in your loan file in the event of audit and to substantiate the uses of the funds. Now, the documents to submit with the application include the application and the calculation form that's embedded in it, the PPP application Schedule A, all payroll records, that would be bank statements or payroll service provider records, Form 941s if you have them, that's a payroll tax reporting form that the IRS uses, and payments receipts for health insurance premiums and retirement plans. You've also heard about the full-time equivalent calculations on this recorded conversation from Mr. Luker, and you'll need that documentation, as well as evidence of the mortgage interest payments, evidence of the rent payments, evidence of lease payments, and evidence of business utilities that were covered, again, in the forgiveness application. So all of that documentation must be submitted with your 11-page application, including its schedules and the forms. Now, there are other documents that you as a borrower need to maintain, but that are not required to be submitted with your application. Nonetheless, the application expressly provides the following information must be maintained by the borrower, and that is documents supporting employees listed in the PPP Schedule A worksheet, FTE reduction exemption documentation, such as written return to work offers, documentation of terminations for cause, as well as any restoration of the reduction in headcount or wages that was done by June 30th. And then your entire loan file must be maintained. And that would be documents supporting the necessity of the loan and the calculation of the loan amount. Many of our clients, for the necessity requirement, have performed pro forma financial analysis, a best case, expected case, and worst case analysis. They've written management memos to the file. They've had board meetings. All of that, minutes of those meetings and the memos to the file, the financial projections, the supporting documentation for the loan application to begin with, all of that information must be maintained by the borrower. That's what we have for the process. Any questions, Glenn?
No questions from me, Max. It's clear that it's a very detailed process. A lot of documentation has to be provided. They're very serious about the documentation, that it's just not a matter of providing a list of expenses, that the backup has to be provided, canceled checks, bank statements. So certainly, I think we would encourage anybody who is filing a PPP loan forgiveness application to consult with their CPA, Certified Public Accounting Firm, and certainly to have their counsel to review the application. So good. Well, thank you for that presentation on the how-to aspect of this, Max. So as business lawyers here at Offit Kurman, whenever we're engaged in a business transaction, which a PPP loan is, PPP loan forgiveness is a kind of business transaction, we always must be mindful of the tax impacts, which sometimes can be nominal and sometimes can be substantial. So here with the PPP loan process, we are mindful of the tax impacts. And Steve Luker is going to talk about a couple of the tax impacts of the PPP loan forgiveness process.
Thank you, Glenn. Yeah, there's a couple of things to bear in mind. Initially, when the statute was passed, when the act was passed, came out and said that loan forgiveness would not be taxable income to the borrower. Typically, when a loan is forgiven, the borrower would recognize what they call cancellation of indebtedness income. But the act specifically excluded that. However, the IRS responded quickly by saying, because you're getting this money for free, you can't make associated deductions. So for instance, the amounts that are being paid for payroll, you're not be able to deduct those where you're being forgiven on the repayment amount. So it's a wash really to those businesses, but there is a segment of borrowers that will benefit from this that I see, who are the self-employed persons. They are basically receiving from this owner compensation replacement, and so they're not taking a deduction for their own compensation. So as a result, they'll be forgiven those amounts. There will be no tax income consequences to them, and they're going to benefit. And also another thought, maybe going off the script a little bit, is this is not a tax issue, but just recently with the change from the 8-week covered period to the 24 covered week period, self-employed persons that were earning over $100,000, their loan amount was $20,833. Under the 8-week period, they would have forgiveness for $15,000 and change. So now that that's being expanded to 24, they could potentially be forgiven for the whole amount. And that's with the caveat of there's still changes that are happening and interpretations every day that we'll have to look at that to see whether in fact that will hold up over time.
Thanks, Steve. Thanks for that. Those tax tidbits, always important. And thanks for that secondary insight. And that really is a good segue into these laws have been since February, have been changing on a daily, if not more frequent basis. And here at Offit Kurman, we're tasked with helping our clients in this extreme time of need. So we're keeping up to date with the changes in the laws. And we've helped hundreds of our clients through the PPP loan application process, the forgiveness process, and also the EIDL, Economic Injury Disaster Loan process under the CARES Act. So we're here to help you. If you need help, please contact us. On behalf of Max McCauley and Steve Luker and Joe Armstrong, I want to thank everybody very much, and we'll look forward to talking with you soon. Everybody have a good day. Thank you.